Hello and welcome to this very special broadcast of Budget 2019. It promises, last half an hour, we're in the last leg, less than 30 minutes away from Finance Minister Piyush Goyal presenting the last budget before the general elections. A lot has been spoken about, written about and discussed about the contours of the budget document. Will it contain relief for the middle class and will it provide a much needed farm relief package? Well, we shall get the answer in an hour or so. But what we can definitely tell you is that the market is approaching this budget with a lot of gusto.
Yes, and we've got two big market voices joining us right now in the show. Aditya Narain of Edelweiss and Umang Papneja of IIFL Investment Managers. Both of them are here with us. Gentlemen, thanks very much for taking out the time. Obviously, the market, is treading a very cautious path ahead of this budget, or probably something that has already been baked in, and that's why no major reactions are anticipated. But Aditya, I'll come to you first off. What is your anticipation? And from a market standpoint, how do you expect a reaction to be, if at all, they go a little bit more populist this time?
Okay, so in some senses, the way this budget is positioned, it at the end of the day is going to have only a limited impact from a market perspective, simply because it sets the base for what the government will do the next time around post the elections. But it's unlikely to be decisive or the route ahead necessarily for the next 12 months. So I think that's one bit. I think from the second question that you effectively asked, is it going to be populist or otherwise? I think clearly it's going to be more income and consumer friendly than necessarily capex or investment led. And to that extent, I think you can argue that there's an element of populism in it. But I think more fundamentally, it is going to look more at the income side, more at the consumption side, rather than necessarily on the capex or the investment side.
So what is it at Edelweiss that you guys have built in, when you made your estimates?
Yeah, so effectively what we are looking at is, what we are really arguing for is that there actually should be a fiscal stimulus going into the next year, because you do need to get the business cycle moving, you do need to get consumption up, and you do need to get expectations and effectively the mood up. So to that extent, we are really saying that you should actually expand the fiscal a little bit, come in with some of these schemes, but make sure that they're somewhat measured.
Umang, good morning. What is baked in according to you? And if indeed there are no big negatives, is there a trigger for the markets, or do you think the markets will move independent of what comes out today?
I think it's very fair question. I think what's happening here is that markets going in with a lot of negatives. So whether the talk about too much for the farmers, or talk about a big RBI dividend and things like that. So and lower GST collections, fiscal slippages. So everything's kind of, I guess, markets expecting such kind of negative news, and plus the positions are lighter. So honestly, I don't think it's going to be as negative as the market thinks. It's going to be much more neutral. And on the backdrop of what's happening in the Fed and the end of a little bit of the rate hike cycle and slowing of QT, I think emerging market flows are increasing. So generally should be positive, because it will give you not so much of shocks which the market is expecting, I think. The talk of the fisc deficit and the farm package, now we've been talking about that ad nauseum for the past few days. What else beyond this are you anticipating? So Umang, for example, one of the conversations was around the oil and gas space, and the fact that the subsidy that was budgeted at the start of the year has been woefully short compared to the kind of spends that have already happened in the first half. Do you think there will be an additional subsidy burden put on the upstream companies, or will there be some higher budgeting for the subsidy at a time when the budget doesn't allow for some more provisioning for subsidies? No, I don't think that negative should come in. I'm not in that camp. But coming to what you said about what other things should one expect. So there's of course a lot of taxation stuff which is being discussed. But I just want to draw your attention to what's been happening over the few years on trends. The finance minister has been talking about a general trend that long term should be 2 years, right? So he reduced the 3 years for real estate from long term from 3 years to 2 years, and also for private equity investments. So somewhere I don't know if there needs to be some kind of uniformity, and if they increase this long term from 1 year to 2 years, that is something which one needs to be a little wary about. But otherwise, I'm not really going into any shock scenario or something like that.
All right. Aditya, just coming in on what is likely to happen in case, if they maintain their fiscal deficit number versus if they increase it to about 3.5 and thereabouts, the growth in spending, which in a way is very important for the economy. So if they do maintain their fiscal deficit number, which would imply that from a 13.6% spending growth number in the first half of FY19 could drop significantly lower to somewhere closer to 6%. However, if they actually manage to push that number up to 3.5% fiscal deficit, it will be a slightly more moderate tapering of the overall spending number for the second half. How would each of these scenarios play out?
No, I think you've got to run with a 3.5 number, because I'd be very, very surprised if you're squeezing stuff very dramatically in the last couple of months of the year and then talking about an expansion beyond into the next year. So quite honestly, I think a 3.5 number is basically where you're headed. I think that's the number that they should effectively show if they actually compress it a lot, either by reduced spends or by taking too much in terms of FCI subsidies or otherwise. It just reduces the credibility of that number a certain amount. So I think business as usual is probably the way they're going to go, and that'll probably leave you with a number of about 3.5%. I don't, again, as I just mentioned, I think it is, you've already had a challenge in terms of getting the economy to move. I don't think at this late stage, just into an election, when you've got some bit of underlying momentum going, I don't think it makes any sense to actually put it in. I mean, our overall view is that the time has come actually to be a little bit more aggressive with the fiscal rather than continue to tighten or be very, very fixated by a number. Because at the end of the day, if you have to come out of this fiscal overhang, you've got to grow. You have to get it through growth rather than too much expenditure cut.
Would you consider the focus in the near term now shifting away and moving to what the RBI does in this environment of, the kind of dovish statements coming about from the Fed, the interest rate environment that we are in, and quite a few murmurs about a possibility of rate cuts coming in there?
Obviously, the focus will shift event to event, and so it will move just after this budget to the monetary policy. But our sense is, I think a rate cut is now increasingly getting baked in. There's been enough talk about it. The US has reversed stance. There is liquidity in the system. So I think to some extent that is reasonably baked in.
Interesting. Umang, how is the market positioning looking like? One, what I think the point that Aditya made as well, the Fed commentary leaves some room for any central bank across to probably take a rate cut. Add to that the fact that the December core data or a couple of other data points that have come out in the recent past probably warrant one. If indeed the fiscal slippage numbers are not too worse off and the yields don't spike, would you reckon that the rate cut chatter becomes a lot higher?
Yes, I think there is some kind of a synchronized global slowdown, but let's look at how the markets have behaved over the last 3-4 months. So if you just go pre-ILFS days, what you've just seen is the GSEC coming from a 820 odd level to around whatever 740, 750 levels. So that is kind of already, as Aditya was also mentioning, that's somewhere kind of already priced in my view. But when you look at other segments on the curve, so when you look at SDL, for example, which is the state development loans, they from pre-IIFL days of 850, they've come down to 810. So the contraction's not been that much. AAA borrowings are at the same. So AAA corporates are borrowing at the same rates as they were before pre-IIFL. So I think what could have happened is because of the additional OMOs targeted at the GSEC, I think GSEC's already priced in a lot of positives in that sense. But what would happen is probably the other segments of the bond market might do better than what the GSEC would do.
Do you feel that if something comes out which is not favorable to the bond markets and you do see the yields spiking, it will obviously create a little bit of a concern, because it may question how the government is looking to refinance its debt if the yields remain elevated?
Yeah, so at this moment I'm not pricing in that risk, but of course what you should obviously look at the inflation trajectory. So at this moment real yields are extremely high, so it gives an opportunity for probability of safety built into the other aspects of the bond market. So GSEC, as I said, I would say is probably overpriced or priced to perfection, but even if there is a little bit of negative news either on fiscal slippage or on inflation, I think there is a lot of room at the other segments of the bond market. Maybe the GSEC might be punished a little bit, but not the other side of the bond market.
Aditya, what's the market stance right now? I mean, yes, January's turned around a bit in the last 2 or 3 sessions, though propped up by a handful of stocks. But banks, the corporate earnings seem to be coming back. Today, the auto numbers that have come out thus far, well, people must, at least the bulls must be heaving a sigh of relief, or investors must be heaving a sigh of relief there. At least the Maruti numbers seemed okay. What's the market stance right now?
See, I think the only real call that the market is taking is on the asset quality cycle, where I think there is much greater comfort that the worst is behind. You can effectively look forward to a recovery cycle, even though it's going to be a little slow, right? I think that's the one call that it's taking. I think as far as the Maruti numbers are concerned, or as far as the discretionary spend bit is concerned, I think the market is still very much middle of the road. I think there is enough caution, and I don't think that has effectively turned. I don't think this budget itself can bring about a huge amount of turn in terms of stock reactions in these sectors. So I think the one theme that is playing through is really the asset stability one. As far as the others, it's still an area where you're kind of muddling through.
I agree with that point, which is why the question was that if budgets come and go, but the markets do what they do, what do you think the market does for the remainder of the year? Because try as one may, that earlier hope of that 20-24% earnings growth for FY20 seems to be a bit of a pipe dream right now.
So quite honestly, from our perspective, we are cautious on the market. Our kind of target for the next 6 months through till the elections is basically a nifty range of 9,800 to 10,500, because we think some of the uncertainties that exist at this point in time, whether globally, whether domestic demand-wise, whether the fiscal number-wise, I think they are enough to keep the market a little bit more muted than where it is at this point in time. But we also think, I think over the next 6 months, as some of these uncertainties settle down, as you have a new government in place, as you have an interest rate cycle that should have turned in your favor, we think the second half can actually be a lot more robust. But upfront, the risk reward, as far as this market is concerned, is not favorable for anyone who's on the buy side.
All right. Umang, what would you anticipate in terms of earnings growth for the index?
I think what our analysis shows is that whatever earnings growth we are seeing or we are projecting is primarily going to be led by 3 to 4 stocks. So when you look at, for instance, when you look at the trio of SBI, Axis, and ICICI, I think 1/3 of the Nifty EPS is going to come from these 3 banks. Is 1/3 of the growth of the Nifty EPS is going to come from these 3 banks. So what you're going to see is again a concentrated kind of a market, probably money flow going into a few stocks. Active investing probably will be difficult for people to beat the benchmarks. I think that's going to be the norm for some time, I guess. And also with the recent SEBI reclassification, the whole actions moved to only 250 stocks that way. So 92% of the mutual fund AUM is in the top 250 stocks, if you see. So I think it's going to be a little difficult for benchmarks to be beaten by fund managers. Should be slightly constructive, 4 to 5% upside, but as growth slows down globally, it's not going to be a runaway bull market for sure.
All right. Got it, gentlemen. Thanks so very much, Aditya as well as Umang. Appreciate both of you taking out the time and speaking with us on this very important morning. We're just a few minutes to go for at the beginning of this speech. 15 minutes to be precise, but you can't get away with without bringing in one more market voice. Saurabh Mukherjee, he's joining in right now from Marcellus Investment Managers. Saurabh, thanks very much for taking out the time.
My pleasure.
So, obviously everyone has looked at what the numbers should be for the fiscal deficit. My question to you, not being the fiscal deficit, is is there anything else outside the fiscal deficit that should be watched out for that could get attention of the markets?
I think the central attention today has to be on the bond market and onward to the RBI policy next week. Difficult in a pre-election budget, even if you don't call it a vote no count. Difficult for the government to do much for the stock market on a day like this. But if the FM points to both 3.3 to 3.5% deficit this year, which I think he will, and a similar number next year, then I think it paves the way for a 50 bips rate cut from the RBI next week. The Fed, I think, has given a big sort of bonanza to the NDA.
But do you think they'll be so aggressive to cut 50 basis?
You can't ask for more propitious background conditions. You got food inflation negative, CPI under control, oil at 60. The Fed is saying they don't want to do rate hikes going forward. Given all the politicization of around the RBI governor last year, I'll be very surprised if Shakti Das doesn't put through a 50 bips rate cut. And all that the FM has to do today is be reasonably disciplined on the fiscal front for FY20.
And not go all out with
so there will be populist announcements, but as long as he points to a broadly sensible fiscal deficit figure for FY20, somewhere say in the ballpark of 3.3, 3.4, I think the bond market will sort of give the NDA overall credit for reasonably significant fiscal consolidation in the 5 years. So there will be some pro-poor, pro-farm announcements. Difficult to see, given the recent election reverses, how Piyush Goyal doesn't do a farm subsidy. But I think it'll be within reason, and most importantly, they'll point to a modest budget deficit figure next year, paving the way for a 50 bips rate cut from the RBI.
I just want to come in. So you're saying if there's a modest farm package that they announced, that's probably what the bond market has baked in?
Yeah.
All right. So
0.5% of GDP, I would say, is broad figure that they'll target in terms of the farm subsidy package. Obviously, it's very difficult for them to cut some spend somewhere else. So they will point to buoyant tax revenues for next year. Whether the tax revenues come or not is a different question altogether, obviously. But I think without pulling back anywhere, they will try to find a 0.5% extra SOP for the farm subsidy. And in order to keep the bond market's apprehension under control, they'll have a 3.3, 3.4% deficit target for next year. And off we then go to the RBI policy, which I think is a 50 bips rate cut.
Okay. So 1 lakh crores additional for FY20. What goes in the assumption? Because if you assume a tax growth of over 15%, people will see through it. If you assume expenditure growth lower than 10%, people will see through it. How do you manage this additional 1 lakh crores?
So I think so there's two parts to it. I think you're right that if you assume too much buoyancy in indirect taxes, the market will worry. If you assume buoyancy in direct taxes, the market won't worry. The BJP's built good credibility as a government. Yeah, exactly. Yeah. So on indirect taxes, they'll have to be sensible in what they project. My reckoning is, once again, they'll project 80,000 crores on the disinvestment front. And if I was in the FM shoes, I would even use the P word, privatization. There's no harm in doing it. You don't mention any specific company. You say we are open to privatizing, Air Indias of the world. You'll raise the spectre, therefore, of a strong FM who consolidates fiscally. And as long as you point to a number of 3.3, 3.4, I don't see the 10-year bond yield running up. Provided the 10-year bond yield doesn't spin up, and I stress again, the Federal Reserve couldn't have given a better gift to the NDA 48 hours ago. With that backdrop, reasonably disciplined budget, even with a 0.5% farm subsidy, I think triggers an RBI rate cut in the next policy.
Okay, would the assumptions about the Bimal Jalan Committee recommendation and an RBI Bonanza find its way here, or because this is not the medium to do that, they will not even mention it?
No, so what they'll have to give details about is what is the final RBI dividend for this year.
Right.
There's already been a chunky dividend. I think there's an equal.
40,000.
Yeah, so there's another equal amount coming in that vicinity, I think, in the remainder of the fiscal. You're right, it'll be inopportune of the FM to talk about the Jalan Committee, but I think the bond market will read between the lines and figure out that the Jalan Committee will do the job.
You seem sanguine about the bond prospects today. You don't seem to be believing that the yields will spike up in any fashion whatsoever.
Yeah, I think the reason I'm sanguine is I think the Fed's made me sanguine, right? When the American central bank says, not only are we not going to hike, we're going to stop shrinking the balance sheet, and they said both.
Yes.
Right? We're going to stop shrinking the balance sheet. You immediately release the pressure on global bond markets. The American 10-year bond yield is the world's risk-free rate. It's been spinning up for the last 24 months. I think it stopped spinning up this point in. Where our challenge in India actually is not the long end of the bond market. I think the greater challenge is in the short-term money market, the NBFC, the promoter SPVs and so on. Those challenges continue. But I think from a bond market, the long end of the bond market perspective, I think the outlook does become more benign this point in. Courtesy the Federal Reserve, and courtesy the presumption is a reasonably well-behaved finance minister in his speech today.
So how would the dynamics play out if you are seeing the bond markets, if they do react and you do see an upshoot in the yields, and an accommodative stance that the RBI would likely take in this global environment?
So in effect, what happens is, I reckon the short end of the bond market, the yields push up, which is a process which I think is underway. All the promoter SPVs, the housing finance troubles, I think will tighten the bond market further, right? And at the long end of the long end of the yield curve, the yields come down. So you have what is called a flattening of the yield curve, which is a classic indication of an economy in slowdown mode, which I think is true for India and for the world at large. The global economy is slowing down. The data is pretty clear now. And as I've said it several times before on your programs, I think 1Q of the current fiscal, that 8.2% growth print was the height of this economic cycle, and we are slowing down since then. All the data, the CPI, the inflation data, the industrial production data does point to an economy slowing down. When an economy slows down, you do get the yield curve flattening, and I think that's exactly what we're seeing. Short end goes up, long end comes down. The central bank does what it can to stimulate the economy, but the yield curve continues to flatten out.
What is your sense, and what would your best guess be with regards to what the mode of the package is going to be like when they announce the farm package, if at all?
So, I mean, look, the two proposals which various people have put on the table is, one is a Raithu Bandhu style.
Yeah, that's what that 1 lakh crore excess.
And the other is the Arvind Subramaniam, Josh Fellman idea of some format of universal basic income, 800 rupees per below poverty line family per month. But whichever way you cut it, whether you cut it to the Raithu Bandhu way or the Josh Fellman, Arvind Subramaniam way, I think you're looking at something which is around 0.5% of GDP in terms of the outlay. It's a punchy number, punchy enough to swing potentially seats in parliament towards you, but modest enough for you to persuade the bond market that I'm not an indisciplined finance minister.
What about subsidy conversion?
Tough. Pre-election, which subsidy do you convert? I mean, it's a really tough thing to do. Remember, one of the things we've seen in our country for the last 5 budgets which immediately follow an election is overall government spending growth falls very sharply after an election. So you can promise subsidies in this, say, universal basic income, cut back elsewhere after the election, right? And you'll deal with the consequences. You deliver to the bond market the promised fiscal deficit, but you get the election kicker, which is a brand new, glossy subsidy program, which hasn't been seen before in our country. Given the NDA's behavior, I'll be astonished if we don't see a brand new glossy subsidy package being unveiled.
So big programs, big announcements, maybe not big outlays. Could that be the thing that happens in this interim budget by the interim finance minister? That's the question that probably stays on top of the mind of the markets. As we speak, just about 5 minutes left for before the budget speech technically supposed to start, and we are absolutely flat. I mean, the Nifty Bank is at least flat. That is that one barometer that I'm looking for. The bond yield should come up on your screen, and let's just see what they are pricing in right now. Should come up 7.29. So the 10-year at about 7.29. In fact, a bit of a cool down for the yields compared to the last 3 days. So that's the other bit to monitor. I don't think the currency markets move too much really, but let's bring that up as well. 71.1925. So those are the monitorables. We are approaching this. At least the equity markets are approaching this the last couple of days with a fair bit of gusto. Mildly bullish, if you will. Let's see what happens in the policy. The one key thing, sort of just wondering, there's a lot of chatter. To my mind, it's unfounded, but there's a lot of chatter about whether there could be some tinkering done to a measure that was announced last year, which is capital gains. I'm just thinking politically, does the finance minister have the gumption to say that, hey, we introduced this with much fanfare last year, we've gone wrong, we are pulling it back because it's not done too much?
Yeah. So look, I mean, I've been in India for 10 years now, and I've sort of seen the Mumbai capital markets fantasies about either STT or LTCG. It's one of those sort of old favorites where every broker, fund manager has a dream before the election. I'm sure Mumbai wants it. I'm not sure the FM is in a position to deliver such a sensitive announcement. It's not fiscally obviously that relevant, but politically it's a very sensitive subject, and I'm not so sure he'll has the political room after 3 assembly election reverses. It'll be astonishing if he does it, especially since both it's only a year old and this is the budget before the election.
Yeah, and also doesn't kind of give out the message that you want for your vote bank, right? I mean, why do you want to please that X square kilometers in Mumbai?
Stockbrokers never won you election last time.
Yeah, I guess so.
The other thing, anything expected on the personal front? Would you anticipate anything?
He could well, talk about the middle class and that income taxes, and especially the lower end of the tax slab. So perhaps from 2.5 you go to 3.5. Those will be, I think, more cosmetic than substantive. I mean, it's not a massive mover on the tax front, and he's a smart man, rank holding chartered accountant. So I'm sure he'll have a couple of such moves where the fiscal cost isn't particularly large, but emotionally, the middle class goes away happy, saying these people have done the job for us.
Yeah, well, and that's also the other reasonably large vote bank, which is kind of now veered around between this side and that side, so maybe an apt one to please as well. Okay, I think we should take a small break on the note that autos which is leading the charge because of the auto sales numbers, presumably that has come out. Eicher, Maruti, Hero MotoCorp are amongst the names. Mahindra & Mahindra about 1.5% higher. Not a bad way to enter the budget. Take a quick break, and we come back with most probably the finance minister presenting the interim budget. Stay tuned to Bloomberg Wind Live.